we have been talking a lot about debt and equity as an asset class through the COVID period and throughout over last 4 years. But in this year, we kind of at the beginning had thought that we'll bring for our audience new perspectives, new fund managers, and alternate styles and alternate asset classes beyond debt and equity. And in that stride, today we have Mr. Kunal Moktan, who is the co-founder of a very well-known platform by name Property Share. Kunal brings with him around 18 years of experience. He has done his master's in business administration from IIM Ahmedabad, and before that, he has done his honors in finance, accounting, and economics. So over last 18 years of his experience, he has worked throughout with real estate as an asset class. And this property share platform he had co-founded 8 years ago. And obviously the platform has been very successful, and they have been kind of doing really credible and good work. And in that context, we have partnered with them to understand and deep dive the space of commercial real estate. So to begin with, I would want to first of all understand from investors' perspective, Kunal, from you, how is it that commercial real estate as an asset class performed in the past versus other asset classes? And because we are starting this event with 5 minutes delay, I forgot to welcome you. So formal welcome to you to this platform. And over to you. You can kind of give us your opening remarks and how commercial real estate as an asset class has been performing in the past, to kind of understand and excite us to kind of deep dive further for the future investment opportunities.
Yeah, thanks a lot, Kamal, for the introduction, and welcome everybody. Sorry for the bit of a delay, but it's good that we are off. I think you captured my profile quite succinctly in the introduction. I would just like to add that I was part of a 3-member team that started Blackstone's India operations in 2007. 3 of us started Blackstone Real Estate Fund in India in 2007, when Blackstone had invested nothing in real estate in India, in fact in emerging markets. And then we built up a portfolio of close to $3 billion of primarily commercial real estate in India from 2007 to 14. Blackstone, of course, ended up becoming the largest office landlord in the country, and it still is. The first REIT that came out, the Embassy REIT, all those assets were bought by me when I was at Blackstone. And we lobbied SEBI very, very hard for REIT regulations, because our portfolio had become so big that the only way to exit the portfolio was through a public market listing. And there were no REIT regulations at the time. So I've been very close to commercial real estate, rent-generating real estate investing over the last 20 years of my career, of which 8 years was at Blackstone institutionally. So got to understand how institutional analysis works, how institutions think about investing in real estate, especially commercial real estate. Blackstone obviously is the largest alternative investment manager in the world. They manage $1 trillion of money, of which almost half is in real estate. So I got a pretty close view of how real estate works internationally, as well as saw the growth of real estate in India from 2000 all the way till now. Coming to your question, so the way real estate has emerged as an asset class, especially commercial real estate, has mostly been through the advent of multinational companies who saw India as an opportunity to set up a lower cost destination to outsource processes which were a lot more expensive to do in their home country. So people like Microsoft, all the banks, Goldman Sachs, JP Morgan, Morgan Stanley, Credit Suisse, tech companies like Amazon, for them there were certain processes which were very, very expensive to run out of America or Europe. And then they saw that India had this massive population of English-speaking graduates who were particularly good in these processes. So they had been outsourcing manufacturing to China, but China, because of the English language and so on, was a lot more difficult to go to for these processes. So they started India with call centers, as you know, in early 2000. And then over time, they realized that the Indian working population was a lot more, they were wasting the talents on these call centers, and they could do a lot more. So they started kind of bringing more processes to India. Goldman Sachs, for example, does its entire research out of Bangalore. Target, the multinational retail giant based out of the US, they do their entire store planning, analysis, everything out of Manocha Business Park in Bangalore. Similarly, IBM and so on. So that's what happened, and that kind of drove these guys to come into places like Bangalore, Pune, Hyderabad, NCR, and set up big offices and campuses, which basically led to this creation of this asset class over the last 20 years. And then when that happened, that's when all private equity funds came in and said, look, here's an asset class that's giving me, at that time, 9-10% yields on rents. The tenant is Goldman Sachs, AAA, Fortune 100. The lease is for 9 years. There's a lock-in. The guy is doing the fit-out, so he's not going to leave. And the rents are $1 per square foot. At that time it was 39 rupees, which was what the dollar was at. And then they said, look, this looks like a great asset class to invest in. Why don't we get our investors to go and invest in this asset class? So they started opening up India offices. People like Blackstone, JP Morgan, Merrill Lynch, Oxford, all of them opened offices and started looking at this asset class. But the mistake that everybody else made was the fact that they looked at early stage investing in land, under construction, greenfield. And that is where they burned their fingers. Whereas Blackstone waited for the lower risk asset, which is the completed rent generating asset, where yes, the IRRs were not 25%, they were 20%, but the risk was much, much lower. And that's how people like Blackstone built such a big portfolio. They exited at 5 times the investment amount in the REIT. They are still exiting. It was a very, very successful investment. And I gave you a bit of a background of real estate and how the sector has evolved. If I talk about how that particular asset class has performed versus other investments, I'll just pull up a slide. I don't know if you can see this, but if we kind of plot from 2011 over the last 12 years how different asset classes have performed, clearly equity has performed very well, but not exceptionally well. If you see, yes, the Sensex has moved from 100 to 300, 3x in the last 11 years, but commercial real estate is 2.8 times, not very far behind. And the risk of investing in commercial real estate is much, much lower than equity investing. Here we are talking about, like I said, completed rent generating real estate, which is going to give you 8-9% returns on a yearly basis. The beauty of it is it's linked to inflation because the lease is structured in a way that the rents go up by 5% every year. So your 10% yield becomes 10.5% next year, it becomes 11% the following year, and so on. So if inflation goes up by 5%, the returns you're making from the asset will still buy the same basket of goods that it was buying a year earlier, which you can't say for any other asset class. Fixed deposits, AAA bonds, you just don't get that inflation-linked return. And the final feather in the cap for commercial real estate is just the underlying growth of real estate. Because the rents are going by 5%, if you keep selling at the same yield, the underlying land also starts going up, and you start making capital appreciation. So it acts as a hybrid instrument where you end up making 14-15% returns in a pretty safe asset class.
Sure, right, Kunal. This is quite interesting. So, now moving on to deep diving commercial real estate as an investment opportunity. You have kind of given us this context that last 10 years, real estate as an asset class has kind of not stayed much behind equity as an asset class in terms of its returns broadly, if compared to, the heavyweight indices. However, we have always heard that real estate as an asset has always been, one of the larger allocations with regards to any HNI or ultra HNI client. Do you have any data to kind of, substantiate that how important and how big has been allocation of real estate for for HNIs overall, and maybe then subsequently when real estate plays such an important role, how is it that it makes money? We understand that from fixed income as an asset class, one makes money in a linear way by way of coupons or by way of interest rates. But on the other side, with regards to equities, it is largely in terms of appreciation of the stock price, as well as dividends are kind of earned. But how is it that practically investors have made wealth, and how does it work in terms of earning from real estate?
Sure. Let me speak about how the investment returns work first. On real estate, I touched upon it briefly when I spoke earlier. But let me just pull up this slide, which will make it quite clear. So here, if we see, if we make a 100 rupee investment in commercial real estate, the way the returns work is you get 8 rupees a year of rent on that asset, right? Now so you make 8 in the first year. In the second year, the 8 goes to 8.4 because the tenant has to pay you 5% more as per the contract. In the third year, you make 8.8. In the fourth year, you make 9.3, and so on. If you were just to do an IRR of this, you would have made close to 8.8% over 5 years, right? So that's kind of almost guaranteed. You know that this is going to happen because the lease is for 9 years. The guy is locked in. He's done all the fit outs himself. He spent considerable amount of money in it. So you know that this is something that is already known and that you will get. Now on top of that, what you can also get, which is the light blue box, is the capital appreciation in the underlying real estate, which is the land and the building, right? And the way that works is in two ways. So one is purely mathematical. Let's say that I'm buying this asset, like I've said in this example, for 8 rupees, 100 rupees at an 8% yield, which is 8 rupees, because commercial real estate trades at yields, which is also called capitalization rates or cap rates. So today the cap rate is at 8%. So I know that if I buy something which is high quality, tenanted to a multinational in a good location, then I'll get 8% returns. Now a year later, as you can see, the 8 goes to 8.4. Now, if the yield remains the same, the yield doesn't change a lot. If the yield remains the same and it's still 8% in the market, then I can sell this asset for 105 rupees a year later, because the guy buying it from me for 105 will get 8.4, which means it's again an 8% yield. It's very similar to how bonds work, right? So if you buy a bond at 8% and the following year interest rates go down, then you can sell the bond for a little bit higher. That's fundamental bond investing, right? So it's the same way. So I can sell this at the end of the first year at 105 rupees, and the guy makes the same 8% return, the buyer. Now what has happened with me is I made 8% on the rents and I made 5% on the capital appreciation. So I have now made 13% without doing much work on this asset, right? And this is true every single year. If I sell it at the end of the second year, I can sell it at 110 rupees and the guy will make 8.8 on that, still 8%, right? So this is so 8 plus 5, 13 is almost something that you will make with a very high probability. Now to take 13 to, let's say, 18 or 19 requires the asset manager to be a little bit more diligent on which assets he's buying. So if you buy an asset in a location which has very low vacancy, which is which has dense commercial real estate, which has residential around it to support that real estate, tenants love that location, then what it means is, for example, let's say Outer Ring Road in Bangalore, which is one of the largest office markets in the country. Multinationals love that location. Rents have been going up there every year. Now, in these cases, what happens is you can make the alpha 4-5% return by choosing the right property with the right location and the right tenant. Because the risk here is, which we'll talk a little later, the only risk here is the tenant can vacate the property. Then what happens, right? So in such a case, you need to be very diligent as an asset manager, which is what Blackstone did really well in India, is, what is, number one, the replacement cost of this asset? Which means if I were to break down this building and buy the land and build it again, what would be the per square foot price versus what I'm paying today? And never buy a building at or higher than replacement cost. Because what that means is the guy next door can build more and more and cut you on rents. But the moment you buy at a discount to replacement cost, Then if the developer buys the second plot of land close by, builds an office, which will cost him more than what you bought it for, he has to increase the rents to make the same margin, because there's no other way to make money on that. So one is buy at discount to replacement cost. The second thing is look at the rent and see whether it is at market, below market, or above market. So let's say Outer Ring Road is at 100 rupees today, and this particular tenant is paying 110 rupees for some reason. Maybe the developer got a better deal with him, gave him rent free for a year so that he gives you a slightly higher rent. It's very typical in the market. But a lay investor would say, oh, you know what, 110 is the rent. I will buy it for 1,000 and make 11% return. But the fact of the matter is that this guy's lease when it comes up, or the lock-in when it comes up, the market is at 100, so he can go to another building very easily. Or he can, even worse, negotiate with you saying, I will go to another building if you don't reduce this to 100. So if you start buying these offices at market or above market, then you are exposing yourself to leasing risk. The moment you buy below market, let's say it's at 80 or 90 rupees, then you know that this guy will never leave this building for rent. He might leave it for other things, but he will not leave it for rent. So these 2 or 3 things, if you can take care of, then you can make this alpha, which can take you to 18-19% returns. So, to answer the first part of your question, that's how returns would work in commercial real estate. To take you to the second part of the question, which is how HNIs have been investing in this asset class. Obviously, this asset class has been very, very popular with ultra HNIs and HNIs over the last 40-50 years. Indians love buying real estate. Indians love current coupon on their real estate. The fact that it gives you this 8% year on year, you can plan so much with it. You can plan your retirement. You can, that the cash flows are consistent. Therefore, what HNIs have done over time is created a portfolio around commercial real estate. And in the olden days, what used to happen is people used to come together and buy property because the ticket sizes are very high in commercial real estate, 20, 30, 40 crores, sometimes 100 crores. So if I take the example of Nariman Point in Mumbai, for example, prime real estate at one point of time, most of the buildings in Nariman Point are owned by Gujarati businessmen or Marwari businessmen who own floors amongst their family or friends. Blackstone used to be in Nariman Point in Express Towers, and JP Morgan used to be in the adjacent building in Hext House. They used to write 40 checks a month as rent because there are 40 different investors for the floor. And this is something that obviously people have been doing because they know JP Morgan is a great tenant, 9% return is great, Nariman Point is a good location, and that's worked really well for them. But for a normal person or a retail investor to participate, you just can't, because you don't have 10 crores. You might not have 10 people willing to invest with you. So how is it that we can participate in this asset class without having such a high threshold for investing, which is how, of course, we founded Property Share, slightly diverting from the topic. But about 40% of an Indian individual's wealth is in real estate today. And if yours is not, then you're missing out on a very, very big asset class in your portfolio.
Sure, right. No, this is quite insightful, Kunal. So, while we have already, built the case for commercial real estate, and it is interesting to kind of, understand further with regards to doing any investment, the quality of that investment, the process, I would say behind selecting that investment is very important. So how does your company kind of operate in this field? Obviously, you have evolved over last 8-9 years. You would have had various experiences. Maybe you would have done some mistakes also, because every asset class has a risky and a dirty side to it as well. Obviously, you want to show the quality side, but from a investor point of view, I want you to kind of share with us not only your learnings, but what is the current process, and how do you kind of demonstrate that the investment that you offer in commercial real estate as a fractional ownership has a quality asset behind it.
Sure. So let me kind of pull up a slide which will show you some of the And this is from an article that I wrote many years ago. It's available on our website, 10 Commandments on Investing in Real Estate. It was published in the Economic Times. And, you know, I mean, I looked back at this today, at the same article, and I kind of realized that nothing much has changed. And nothing much has changed in 20 years of investing, to be honest. You know, from even today, Blackstone is doing the same thing that it was doing 30 years ago. And, you know, and that's the beauty of investing. If you do the fundamentals correctly, especially in such a simple asset class like real estate, then you end up making decent money. The first false move that a lay investor would make in commercial real estate is just, you know, thinking of what I would say, reacting to the market without understanding the fundamentals of that particular asset class. Like, you know, I mean, an announcement in a, you know, we've seen that a lot in stocks. Suddenly go and buy that stock without realizing, you know, I mean, this is something that might be built in the price, an efficient market hypothesis or whatever. Similarly, in real estate, people read something in the papers and they're like, oh, you know, for example, there was an article a week ago saying 2022 was the best year in commercial real estate ever in India, which is great. It's absolutely true. 51 million square feet of leases were absorbed. But the fact of the matter is, in 2020 and 21, there was very little leasing because of COVID. You know, so there was a lot of backlog. It doesn't mean that 22 was a blockbuster year. And 20, if you look at that and buy real estate thinking 23 is going to be great, then you know you're going to be in for a surprise. You might end up paying a little bit higher than what you should have. So coming to the question on what we look at, the first and foremost thing in real estate is location. You know, that's very, very important. If you buy in a peripheral location or a location which is upcoming, then you're taking risks. You know, for example, in Bangalore, if you go to North Bangalore, close to the airport, that's risky. In Mumbai, if you go to Navi Mumbai, then it's risky. It's not, demand is not fully established there. You're betting on some things to happen. If you go in NCR to Greater Noida instead of Noida and Gurgaon, or if you go to Faridabad, you know, or Dwarka, then you are taking certain risks. And the returns from that risk might not always be commensurate. So you need to just be aware that return and risk, like we know in investing, they go hand in hand. The higher the risk, the higher the return. But sometimes, if you take a little bit more risk, the returns might not be as much as you've taken that risk for. You know, for example, you buy under construction real estate, thinking this is good value. But the fact of the matter is, even if many things happen there, like the guy completes on time, which is a big risk, interest rates don't move, which is a big risk, then you find a tenant, which is a big risk. All of this, if they happen, then the return you make will still be only 200 basis points more than what you would have made if you had bought a completed asset. So, you know, that's something that investors should kind of look at. The quality of the asset matters a lot. If you buy a grade B building or a grade C building, for example, in Bombay, if you buy something in Jogeshwari, which is kind of a standalone building, not by a tier 1 developer, there are 20 tenants, there's a lawyer, there's a chartered accountant, then that's a building that will most likely not be liquid when you sell it. And the tenant is the first one to vacate when something happens, like COVID. You know, and these are the tenants who left first in these standalone buildings, no management, no real support, nothing. But if you go to grade A buildings built by DLF or Punchshield or Embassy or Prestige, then you are betting on the fact that this guy has done hundreds of millions of square feet of offices. He knows what he's doing, and tenants like that kind of a development. The third thing is, what's the demand and supply? So obviously, you know, if the first thing we look at is, if you're buying something on Outer Ring Road, Bangalore, first tell me what are the buildings that's coming up over the next 2-3 years? What's the vacancy in the current stock? And what is it that you're assuming will happen? Hyderabad is a prime example. Hyderabad has massive, massive upcoming supply over the next 4-5 years. And that's a market known for this. You know, there are times when there's no supply, and then there are times when there's massive supply. And Hyderabad absorbs 4-5 million square feet a year versus 11 million square feet in Bangalore. It's a lot less deep than a market like Bangalore. But there's 20 million square feet coming up in Hyderabad. And this is a recipe for disaster. Now, today, even if you go here and buy a high quality building, great tenant, 3 years later, 5 years later, when the lease comes up for renewal, you will face the same questions. Again, the guy is not going to stay with you. He's going to move to a bigger building, better quality building, and you're going to end up losing a lot of money. So the demand and supply is critical. Every 6 months, we do a complete demand supply analysis at PropShare, where we go with the broker to every building that's coming up and see whether what he's saying in the report is actually what's going to happen. We just finished that for Hyderabad, Mumbai, Bangalore. We can share that report with your users. And it's just the difference between Hyderabad and the rest of the markets in India is very, very stark. So that's the third one. Market rent, I already spoke about. The interior fit outs, that's something that's very, very important. And this is one thing where investors get fooled a lot. A developer will say, I'm selling you this asset at 10% yield. And investors like, that's great, that's amazing, 10% yield. Tenant is, Hindustan Lever, very good. But the fact of the matter is what developers don't tell you is that out of that 10%, 3% is actually fit outs, what that the guy has asked the developer to do, right? Which is basically in India, when you buy an office building, you get it like a garage. You have nothing. You only have stone flooring and ceiling, which you have to do everything yourself. And typically the tenants do this, but sometimes the tenant asks the developer to do it, and the developer does it for extra rent. If the rent is 100, he might ask for 120 for this. But the 20 rupee rent is not the same as the 100 rupee rent. One is that rent depreciates over time. You get nothing after 4 or 5 years once the amortization of the fit outs are over. Second is you are buying above market again. When it's 100, you're buying at 120. But investors don't see that. They say 10% yield, let's buy. So, that's something you need to be really, really careful of. Always insist on buying buildings where the tenant has done the fit outs, because that's a big investment from the tenant. To do fit outs today cost 6,000-7,000 rupees a square foot, just the bare minimum. And multinationals spend a lot more than that. They spend 8,000-10,000 rupees a square foot. When they do that, their need to vacate the premises is very, very low, because they've spent so much, they don't want to vacate in 3-4 years. They will stay for 9 years. This is the reason why in India, the leases are 9 years, but the lock-in is only 3 years. The tenant can leave after 3, but the developer can't ask the tenant to leave for 9 years. The reason tenants have asked for this is because the tenant does so much fit outs. He doesn't want to be told by the developer in 3 years, boss, rent has gone up by 20%, pay me more or you leave. They have spent money, their employees are hired, their spouses and their children are staying close by, children are going to school close by. Tomorrow you say, I'm moving from Nariman Point to Bandra. Their entire life is changed. And then they just leave the job and go to some other company. Attrition is very, very big in IT companies. So they make sure that doesn't happen. So that's something that one should figure out, to make sure that you buy assets which are fundamentally the tenant is not going to vacate. So I would say these are the main 4 or 5 things one should think about before investing in real estate. This is what we do at PropShare.
Sure, right, Kunal. So, you had briefly discussed the origination of fractional investing opportunity, by property share. So now let us come to the point, in terms of understanding what is that opportunity all about, because we have obviously understand investing directly into commercial real estate is an expensive proposition. One may not be able to do proper due diligence, and there is a very high concentration risk, putting maybe 1 crore to 10 crore per property. And then fractional ownership obviously offers all those flexibilities and diversified portfolio. But at the same time, we also know there is other way to invest into commercial real estate is through REITs, which is relatively more liquid, right? So obviously, when one is investing into real estate as an asset class, one is seeing that asset class different from equity from the point of view of risk, because equity is non-linear asset class. Investing into real estate seems to be a linear asset class because one gets liquid frequency flows either in form of rents, right? So from this point of view, investor would want to understand that how is a commercial real estate offering as a CRE offered by property share meaningfully attractive than maybe a REIT or directly investing into commercial real estate. So kindly come to that proposition, that how and what is the offering that you have, and how attractive is that in terms of, say, yield and net returns, net of expenses and taxes.
Sure. So there are 3 primary ways to invest in commercial real estate today. Let me just pull up this slide which will show you. The first one is just simple, where you buy directly. It costs 8-10 crores to buy a floor in a building. You can buy that directly. The liquidity in this case is really low because you need to find another person who's willing to pay you 12, 13 crores after 3-4 years to buy it from you. And there are very few, the universe of people who can buy it at 12, 13 crores is very, very low. The volatility is quite low here as well because you own the asset. It's not being traded on a platform or anything like that. Diversification is low because all your 10 crores has gone into one asset. In terms of asset selection, I mean, you are selecting the asset yourself. So you know exactly what you're buying. So it scores high on asset selection. The rental yield 6 to 8% is kind of similar if you buy. If it's the highest if you buy through direct. That's how I would put it. Rental frequency is monthly, and the time and effort required. This is huge because you need to manage the asset yourself. You don't have anybody else to do it. And if this is not your full-time business, then it's kind of difficult. In terms of this is something that has been done by HNIs and ultra HNIs family offices over time. Even today, family offices prefer to buy the asset directly, but they have a 1,000 crore portfolio, so they can buy a 20-30 crore floor across many buildings and still diversify. But a normal retail investor will not be able to do this. In the case of a REIT, which is a fairly new asset class, like I was saying, the accessibility is a lot better. It's only 1,000 rupees. SEBI has reduced it. It started a lot higher when they launched the REIT. And the liquidity is very, very high. So tomorrow, if you want to sell and get money back, T+2, you will get the money straight into your account. So that's something that it scores really, really high on. But the biggest issue with REIT, there are many listed here. The biggest issue with the REIT is the yield. Because today, because it is publicly traded and the prices are volatile, you will not make more than 5.5%, maximum 6% yield on most of these assets. The reason for that is, one, obviously the stock prices have moved up, but the second is a REIT is allowed to invest 20% of its portfolio in non-income generating assets like land. When you do that, even if the yield on the 80% is 8%, on the 20% the yield is 0, and therefore you make 6.4% on your total 100. That's one. The second is they take debt to buy assets. 20% debt is allowed, and that interest rate on the debt in India is higher than the yield. India is one of the unique markets where interest rates are actually higher than the yield on assets, and therefore that also eats into your yield. Because of that, the yield that you make in a REIT is sub 6%. But in terms of liquidity, it scores very, very high. In terms of asset selection, you have no say. You just have to trust the manager. It's like a mutual fund. He can buy whichever assets he wants. He will not come to you and ask you. So tomorrow he goes and buys something in Parel or something in Golf Course Road in Gurgaon or Hyderabad or Chennai. You can't go to see and say, no, I don't like this asset class. So that's something that's how REITs differ. They have advantages, a lot of disadvantages. In securities backed by real estate or platforms, what happens is the minimum investments are lower. So it's not very low, but it's much lower, 25 lakhs. Liquidity is not as high as a REIT, but it's fairly moderate because you can sell on the platform to the investors. For example, we have more than 130,000 users on the platform. So to find someone to buy someone's share is quite easy. It might not take 2 days, it might take 15 days or 30 days, but it's not zero like when you own direct assets. In terms of volatility, obviously, just like direct, you are not traded on stock market, so your prices are not going up and down. The thing about buying a REIT is you buy a REIT, tomorrow it goes down by 20%, you're holding your head and thinking, what the heck did I do? It went down so much by 20%. That doesn't happen in private market investing. Asset selection is very high because in a way, you are the investment committee. There is no investment committee here. You decide whether you want to buy this asset or not. So let's say we list something in Bandra Kurla complex, leased to, we have a building there leased to State Bank of Mauritius. Now, if you are from Bombay, you understand the market very well. You know that this pricing is good. You might want to buy that. But if we list something in Bangalore, you might not understand the market and you might say, okay, let me not buy that. I will buy something that I understand. Similarly, a Bangalore guy will prefer a Bangalore investment to a Mumbai or a Hyderabad investment. So the asset selection is done by the investor, exactly like in a direct investment. which is a big advantage. You can choose where you want to put your money depending on what you feel is a good market. The rental yield is much more than REIT, 7 to 8%. Rental frequencies again monthly. It's almost the same as buying directly yourself, but at much lower thresholds and with liquidity. And in terms of asset management, you don't have to worry at all because our asset management team manages the entire asset very actively to make sure that your returns go up even more. Asset management is something that I really learned from Blackstone. Blackstone places a lot of emphasis on asset management. It's not only about buying, but the mantra of Blackstone is buy, fix, sell. You buy something, you fix it over the 3-4 years, and then you sell it. So, for example, you might buy 80% leased building, 20% vacant. You put in the time to lease that 20% at slightly higher rents, and when it's 100% leased, you sell the asset. Or you buy a hotel. You put in 30 more rooms in the lobby, you change the configuration a little bit, increase the operating income, and then you sell it. So this is the way you make that small alpha return for your investors. This is how Blackstone is able to generate 18-19% IRRs over the last 40 years. And that's why they have $1 trillion of assets under management. So asset management, we have a separate team that does that. There's a separate person who leads it. And there's a very high focus on working with the tenant, meeting them regularly, making sure they're happy, and adding something which can give us higher income over the next 4-5 years when we sell the asset.
Sure, right, Kunal. So, I was just looking at the chat from the audience. One of the, I would say, members in the audience has asked a very pertinent question. And that question always comes in mind, when all the more you talk about the success of your platform with, like 30,000 platform users. How is this entire platform based, fractional real estate investing as a, investment mechanism regulated? Is it coming under any SEBI regulations? Or are these regulations already under discussion? Because you have been operating and obviously doing a very good work. That is why you have attracted so many users of your platform. Because out of the audience that we have, there are a lot of HNI clients who are kind of averse of averse of investing in those products and companies which are like just brokers and not regulated by any framework. At the same time, I understand, that this particular segment is growing rapidly, and there are many other platforms which are coming up, and hence SEBI might be coming up with some regulations, but I'm not updated at all. So kindly update us in this regards as well.
So we are the only platform which is regulated by SEBI. We have we work with an IA license. We have a category 2 AIF, which is also registered, and we have a portfolio manager license. Now the way we work is in the platform, you can buy and sell real estate individually. Like let's say we list an asset for 20 crores. You can also come and say, I want to buy the whole asset myself. That is not fraction. I wouldn't call it fractional. I would call it, asset-backed security, which is what we do. There are two parts of it. One is you can buy the asset directly yourself, in which case property share is only a marketplace between a buyer and a seller. And we've done those deals as well, quite a few. So we list something, family office says, I want to buy the entire floor. We charge a lower asset management fee to them. We charge a brokerage and they buy the asset. Right? So that is property share as a platform. If you want to invest a lower amount, 25 lakhs, to buy a part of that asset, then we sell a securitized product, which the asset is bought or sometimes is already held in an SPV. You get equity shares and convertible debentures in that SPV, which owns the asset. And therefore, you own securities backed by, let's say, an office building in BKC, which is exactly how Blackstone also does it. Every other institutional investor does it that way. When the rents come into the SPV, they get distributed to individual investors as interest or dividends. This is also exactly how REITs work. If you buy any units of the REIT, you will see that you will get interest, you will get dividend, and you will get some redemption of your face value of your debentures. Right? So it works in a very similar way. And the way it's regulated is that we use our investment advisory license to advise an investor to buy securities backed by this asset. Very simply answer your question, it is fully regulated by SEBI under its existing regulatory regime.
Sure, sure. And you also, touched upon this point that this is you have an AIF product as well,
Yeah.
and a portfolio management license as well. So you want to kind of touch upon that aspect in more detail in terms of, are you just having licenses, or you have practically funds running under that licenses?
Yeah, we have funds running under the license. On the PMS license, we manage almost, I think, 250 or 300 crores. And we have a category 2 AIF called PREF1, Prop Share Real Estate Fund 1, which is a 1 crore minimum investment registered with SEBI, where we've already invested, which we are actually closing on the 22nd of January. It's been on for a year. We've already invested in 3 assets in that fund. As you know that in a Cat 2 AIF, you have to diversify your income in such a way that more than 25% cannot be in one asset. So there's one more asset that we need to buy, which we will probably be purchasing in March, which will close the fund. So the person coming in today to buy this fund will already get 3 assets, and the risk is only of a 4th asset, because the way people think about a blind pool fund is, where is my money going? How do I trust the manager? I give him a crore, where is he going to invest? But we've already passed that stage. Now we've already invested in 3 out of the 4 assets. So the guy coming in already knows these are the 3 assets I'm getting in. The 4th one is going to be similar. It's only completed, only rent generating. All are multinationals. The tenant is LG. There's one which is LG. One is Tata Motors Finance. We have one asset in Thane, which is Lodha, I think, which is leased to Tata Motors Finance. We have one on Outer Ring Road, Embassy Tech Square, which is leased to LG. And the beauty of AIF is also you can use leverage to buy the asset. You can use that an LRD to buy the underlying asset, which can really increase your returns and also lower tax because of the interest. And you can do that in an AIF, but not in direct investing, because in an AIF you have the benefit of 4 other assets to support the cash flows in case something happens in that one particular asset where you've taken a loan. Because if the tenant vacates, then you still have to bear the EMIs. If you buy it yourself, then you are exposing yourself to that risk, and tomorrow you might have to find other funding sources to make sure that you pay the EMI. But here you have 3 other assets which can actually help you pay for that asset. So these are the 2 products where we already manage money.
Sure. So, with regards to all these offerings that you have, if one has to understand, the perspective of risk, what can actually go wrong? And I had asked you this question earlier also, to kind of discuss with us some of your mistakes and maybe learnings from those mistakes, so that investors is aware, when he's entering into this asset class, that these are the expectations, and this is the kind of, I would say, zone in which his expectations will oscillate. In terms of expected return, you have covered. Now, what could be the expected risk?
Sure. So like real estate as an asset class always comes with some risk. I mean, every asset class comes with some risk, whether it's a bank fixed deposit or equity or even a AAA bond or junk bond. Real estate also has its own risks. What one needs to do is take as much of the risk out of this investing as is possible. Now, you can't take out 100% of the risk. And coming to your point, no one is such a genius fund manager that they will invest in the right assets all the time. That's never going to happen. You are not going to be buying 10 assets, all of which are going to be superstars, 20% returns. Even Blackstone has lost a lot of money. They have entire capital in some of the assets. But what is important is to make sure that 80-90% of your portfolio is performing well, and 20-30% of the assets are going to at least return your capital back, if not make money. What can go wrong is if you invest in, like I said, under construction or land, you can actually end up losing your entire capital in some of these assets. So the way to look at it is, how can I take this asset class and reduce the risk to a minimum level possible? And yes, I know that risk and I'm willing to take that risk. and I understand fully what that risk is, right? So let me pull up the slide where I will clearly lay out what the risks are and what risk you are taking investing in a product like property share. The first investing risk in real estate is zoning. It's the land zone for the correct use. When you buy early stage investing, the land could be industrial, it could be residential, the developer would have filed to change the land use, but these are never mentioned to the investor. You have to really read through the legal reports to understand it, but you are taking that risk if you're buying under construction and early stage product. Title risk is a big risk in India. 10 years later, someone might come and say, this is my land. Why did he sell it to you? He has no right to sell you. He had no right to sell this land or property to you. Now there's going to be a long 20-year case, which is going to take away all your returns. Then there's planning. The development plans need to be approved by the local government agency. In Bangalore, it's the BDA, the Bangalore Development Authority. In Mumbai, it's MMRDA. Then you have approvals like the MOEF, which is an approval you require for every asset, irrespective of which location. Airport Authority of India will see whether your asset is in a funnel zone, see the height of that asset. If you build a little bit more, which builders are likely to do most of the times, they will come and demolish that building. And of course, the biggest risk is development risk. You can't trust a developer in India. Let's be absolutely clear. I've worked with them for 15, 20 years, and no developer has the consumer's interest at heart. His only interest is how to maximize his profit and move the money from one asset to the other to stay solvent for long enough, right? And that's the reason why RERA came in, and there's some amount of regulation now in there. Then there's an increase in cost, which we've seen actually the most in the last 2-3 years. When COVID happened and all the migrants went back to their homes, suddenly when COVID restrictions were lifted, builders wanted to build, but there was no one to build. And they had to pay really 20-30% higher to get the same laborers back. At the same time, petrol prices went up, Ukraine war happened, gas prices went up, inflation went up. The cost of building today is no longer 2,000-3,000. When I started in Blackstone, we could build an office building for 1,200 rupees a square foot. Today, less than 6,000 rupees, you cannot build an office building. That's how steel, cement, and labor prices have gone up. And if you buy, which is an under construction building, then you're taking that risk. And that risk will be passed on to you by the builder in some form or the other. In terms of financing, interest rates, again, which we've seen very starkly in the last couple of years, interest rates have gone 4-5x in developed markets. India has still been fairly fine, but places like the UK, where the Bank of England rate used to be 0.1, has gone to 2.75%. So, this is something that will directly impact the developer's cost, your cost of building this office building. And finally, of course, the biggest risk is the guy builds the building, but there is some deviation in what the planning permission he had got was for and what he actually ended up building. He got 10 floors permission, he built up 2 floors. He had permission to leave 10 meters of space for fire, he just left 4 meters of space. And what happens in the end, the guy will not give you an occupancy certificate. And then you are stuck in a building which is illegal. No tenant is going to come there. And suddenly you can see all your investment, crores of rupees at risk. And the final risk is, will you find a tenant for this building? And can you sell this building after 3-4 years? Right? So this is the risk so if I look at all of these risks, when you buy, forget property share, but when you buy a completed rent generating asset, which has an OC in place, you are removing every one of these risks. You have no zoning risks, you have no title risk, you have no planning risk. The title is clear. The guy has got an occupancy certificate. The tenant has done his own diligence on the guy. There is a debt on the books who's done his own diligence. And the one single risk you are taking is it going to be leased? We remove that as well by buying a leased asset. So therefore, in our case, the risk is releasing risk. What if the guy leaves in 3 years? Will I have a 6-month vacancy or a 1-year vacancy, during which time I get no income? And the way we mitigate that risk, like I've spoken in the early part of the presentation, is buy assets where the guy has done fit outs, buy assets where the rent is lower than the market, buy assets where the price is lower than replacement cost, and this risk is going to reduce to a large extent. Even then, if he leaves, find an asset where the location where the vacancy is low so that you can get someone else as quickly as possible. We've had vacancies in our portfolio in the last 2-3 years. every one of them has got leased in 6 to 12 months, except one asset, which is, if you talk about mistakes that we made, that is the one mistake that we did make. A very high quality asset in a very good location, but the developer had another office building which was 700,000 square feet next door, which just did not get leased. And when our building came up for the lock-in came up, the guy had the option to go to the exact same building next door, where he cut us on prices by 15-20%. Now you can't fault the guy for doing it because he has the whole building to lease. But in hindsight, we should have thought about that risk, which was a releasing risk in that particular building when we bought that asset. So we try to reduce all the risk as much as possible to only this one risk, which is at least manageable.
Kunal, so can you also give practical, experiences of some of the clients of yours during, say, COVID period? Were they kind of seeing any fall in their portfolio values, or was there any delay in the getting the coupons? Like we saw, equity markets went through bad phase. Debt markets over last 1.5 years have gone through bad phase because interest rates have been going up. So likewise, I'm sure COVID, as per common understanding, was a bad phase for commercial real estate. But how was the practical experience for your clients during that phase, and how did you manage, risk at that point of time?
I'll pull up my portfolio in a second of what we own, but COVID was actually very good for. I mean, it was not as bad as what people made it out to be for commercial real estate. In fact, it was quite good. If you look at occupancy rates in parts of REITs, and there are 3 REITs listed today: Mindspace, which has a lot of Hyderabad assets; DLF, which has a lot of North India assets; and Embassy, which has a lot of South India and Mumbai assets. And amongst them, they manage 200 million square feet of prime real estate, and they report every quarter because that's their public. And if you look at their quarterly report and see the occupancy in every one of their parks, it has not gone down below 99%, starting from the March 2020 quarter when COVID. Every one of the quarters, the occupancy is 99.7% to 99.9%. What that tells you is that multinationals, when they invest in commercial real estate, they don't invest with a view to leave that building. It's FDI, it's not FII. People are putting in money, they're getting employees in there, they're doing the fit outs. For example, Google, Microsoft, Amazon, Cisco, they did vacate buildings in India in droves when COVID happened. They just held on. Because for them, I spoke about the fact that in 2007 when we started, the rent was $1 per square foot at 39. Even today, the rent is $1 for the guy because it's 88 rupees, and the dollar has also moved to 88 rupees. So for these multinationals who don't have any revenue in India, all the revenues are in dollars. Their cost of rent is actually the same 15 years ago that it was today. If you think about that, it's a very powerful argument because the guy has basically paid the same rent for 15 years. And for him, rent is such a small part of the cost that he's not bothered about leaving an office building just because COVID has hit. He's willing to wait it out for 2-3 years. So none of these big guys left any of the campuses in India. They stayed put. For them it was low. What went wrong is if you buy, like I said, if you bought a grade B or C building in Andheri or in Goregaon or in Whitefield in Bangalore, which had smaller tenants, like I said, CA firm, consulting firm. These guys are entrepreneurs. Like they want to save costs as quickly as possible. Even startups, for example, they were the first ones to vacate the building and move to co-working or work from home. But a multinational can't do that, And over time, obviously, COVID being such a life-changing event, hybrid working is going to come in. But the demand is so strong for real estate that people are not going to leave their office buildings and move somewhere else. They have not done it. You can see it. In fact, like I said, 51 million square feet leased last year. And therefore, during COVID, commercial real estate was very, very resilient and it did extremely well. Even the escalations were paid. Everything was paid on time. Because tomorrow, if as a developer, I tell Google, okay, fine, if you don't want to pay me, you can leave. For him, it's 500,000 square feet, 5,000 employees being asked to vacate. Nobody wants to take that kind of risk. The multinationals are not going to take that kind of risk. So if you buy the right asset classes, you don't have that risk. If I look at my own portfolio, then we had some vacancies. We had We had in Pune, there was we had a property called Sky Vista, which was leased to a South African media company called Baron Budge and Dominic. They tried out working from home for some time and so on, but in the end, they put up their hands and said, no, we're going to leave this asset. But the fact of the matter is, we had bought it in Viman Nagar in a Lunkat building, very high quality. Within 3 months or 6 months, we got a new tenant, exactly same rent, with a better profile, 3-year lock. Other than that, I don't think we had any building where we did not get rent on time, where the guy vacated the building during this time. So at the 1 or 2 places where they did vacate, we got it leased pretty quickly.
So, moving on to continuing our discussion with regards to risk and regulations. You mentioned that, you're the only platform which is regulated. I will just tell you, one of the elements of SEBI regulations with regards to other asset classes is that SEBI kind of, forces the investment committee and the founders of a particular structure, be it mutual fund or a PMS or an AIF, to have good skin in the game in terms of they themselves investing in the particular product which is offered to the investor or a client. So from that point of view, if I was to ask you what is your skin in the game, or maybe property share skin in the game at an SPV level, when an SPV is created and offered to an investor as an opportunity. So because obviously this is an important question which any investor would want to understand before accessing this asset class seriously.
I would phrase that slightly differently. Wherever there is a discretionary product involved, where the fund manager has discretion over where to put the investor money, that is where not just SEBI but regulators around the world have been very, very discerning in terms of what we should ask the manager to do to make sure that he invests alongside his investors. For example, an AIF, whether it's Cat 1, 2 or 3, you have to invest 5-10% of the fund size of your own money, right? But if it is a fund product, it's not that you have to put your money into this product. There, the guy knows what fund it is. You already told him that this is the investment it's going to make, and therefore it's not very relevant to have someone invest their money into it. In the product that we have, which is rent generating real estate, like I said, the guy is the investment committee. We don't take his money and put it in some real estate. We show him the analysis, we show him the asset, we show him the cash flows, the sensitivity analysis, the financial model, whatever you have. And then you decide whether you want to put money or not. In such a case, it is not relevant that you have to put money in every one of these assets. That's one. The second thing is, the way our skin is there in the game is, our entire fees, or a bulk of our fees is paid when the asset is exited. And that only happens at the end of 4 or 5 years. Until that happens, we are not really making any money. We just have enough to get the lights on in the office. But the whole game here is to make sure that we make enough money for investors so that at that point of time, you can also participate in some of that.
Sure. So if I may understand, the view on real estate as a market, because as you mentioned, 2022 was one of the best years for both residential as well as commercial real estate. And we understand that, these years are kind of followed by maybe, you can say slow years, because this happens in any other asset class. There are cycles involved. So from that point of view, if you were to kind of give a view on investing in commercial real estate as an asset class, because you are kind of, one of the thought leaders in this industry, given your around 2 decades of experience, and absolutely, given your, working with Blackstone, and then obviously having founded this platform, I can say confidently that, you are a thought leader, one of the thought leaders in this industry with regards to this particular aspect. So I am hence wanting to get a big picture view from you with regards to commercial real estate, especially when the hybrid way of working is in front of us. And 2022 has been one of the best years. Prices have already gone up. So from all this point of view, kindly tell us next 3-year perspective of investing in commercial real estate, maybe in terms of cities or locations, or overall, in whatever way you want to attempt to answer this question.
Right. So, I recently sent a very long newsletter to all our users, which was quite instructive, and where I laid out whatever you're just asking, where commercial real estate is headed and what's happening today in the market. And if we look at the last 6-7 months, a year, kind of post the last big COVID wave, then what's happened is the demand for real estate or commercial real estate has definitely gone down because of the hybrid model. Because today, no office or very few, I would say, less than 5% of offices have a full, pretty, 7-day work week like earlier. Every one of them is in a hybrid model, and now the employees are so used to it that changing it is very, very difficult for at least the kind of companies we're talking about in India. Now, Goldman Sachs in New York can still say everybody has to come to office, right? But for an IT company to tell people to come to office now 5 days a week, it's almost impossible to think of. What that means is that the requirement for office space will be much lower going forward for some time at least, unless demand also picks up in a big way. I don't expect the leasing to be what it was, 50 million square feet last year over the next 4-5 years. I think it will be lower, but I don't think it will be half of it. I don't think it will be 25 million square feet. The reason is that a lot of the multinationals are still very small in the presence in India compared to where they can be. Only in the last 2-3 years, Amazon has a 4 million square feet RFP right now floating in the market for office space because they've grown in such a big way. Apple is building a massive technology center in Hyderabad along with Google. And Qualcomm has just built their entire campus or has plans to build the entire campus, about 2-3 million square feet. So over time, what is going to happen now is that the amount of demand for this asset class or space will be much lower, and therefore developers will temper down their supply as well, which will make sure that the rents don't fall or the prices don't fall too much. So to be very to just give you a summary of what I just said, I don't think it's going to go through the roof anymore. Neither do I think that's going to become half. It's going to chug along at this pace for some time because fundamentally the industry is still very, very strong from an outsourcing and a cost angle perspective.
Sure. So let's take some questions from the chat box. So there are certain IRRs mentioned on your platform, historical IRRs. So have those IRRs been delivered to your clients?
So we have sold till date one asset, which is what in India, if you sell any asset before 3 years, you need to pay short-term capital gains tax. So it's quite it's not very lucrative to sell a real estate asset very quickly. You need to hold it for some time. The initial asset that we bought, we sold it in the middle of COVID at an 18.2% IRR, which is actually higher than what we had underwritten. This year, we are selling 3 assets. They are in various stages of being sold. And there, I don't think we will make the 16-17% returns. We will make lower, 300-400 basis points lower. Part of it is also because of the fact that COVID affected, one asset class, for example, is retail, which is directly impacted by COVID. Retail shops could open, so they had to shut down. We had one retail asset out of a 1,000 crore portfolio. We have one asset of 23 crores in retail, where we had to renegotiate the rents and one tenant vacated, but we found a new one. There, the returns are not going to be the same, obviously, because we've had 6-7 months of vacancy, sometimes up to a year. But like I said, the math I laid out in the beginning, that is not right. At worst, you'll still end up making 12 to 13% IRRs.
Right, Kunal, we come to the last part of this section. Would want to understand, who are the other people in your team and who are because you are co-founder and CEO, who is the other co-founder or maybe other key people in your team, and is Property Share backed by, any VC or any private equity fund, or it was a bootstrapped platform? So this is the final question that, I think comes to my mind with regards to this interesting conversation that we are doing.
Sure. So PropShare is institutionally owned. More than 50% is owned by institutions. It was founded by me and my batchmate from Ahmedabad, Hashim. I'll just pull up a slide which shows you who they are. So Hashim is from IIT Kanpur. We were together in Ahmedabad. He is from a tech background. He's the co-founder and CTO of PropShare. And on the board, we have 4 investors. The biggest investor is Westbridge. Westbridge is actually a growth private equity fund which has been investing in hundreds of Indian companies over the last 20 years. They are an $8.5 billion fund based out of San Francisco and Bangalore. They've invested very recently, in fact, it was in the news. They invested 350 crores into PropShare. Before that, we had Lightspeed, which is a US-based venture fund, which also invested in Snapchat, for example, and also they made a big exit in Oyo 2-3 years ago. They are also investors in Byju's. And then we have BNext, which is a Japanese fund based out of Singapore. Dirk is a board observer from BNext. And then there's Pravega Ventures, which is founded by Rohit and Mukul, who were with the erstwhile Safe Partners, now called Elevation Capital. And they started off on their own with Pravega many years ago. They are also investors with us. So we have a very independent board with three investor members and the 2 of us. We also have 3 advisors which are not listed here. A person by the name of Tanya-san, very well-known figure in the asset management industry in Japan, who was the head of Solomon Brothers in 1988, started his own asset management company there in early 2000, very, very successful. We have another person from Blackstone called a German person called Felix Kuna, who runs his own company in Germany. So it's a fairly independent institutional board and management structure.
Sure, Kunal. I think this is quite, a discovery that we have done today, conversing with you and understanding the entire opportunity that you have created, across HNIs, ultra HNIs, and retail clients, ranging from advisory-based, fee-based offerings that you have, as well as the AIF that you mentioned. Looking forward to doing more conversations with you and understanding the product, further. And thank you for your time today, and thank you everyone for logging in case you have any further questions, you want to reach out to Property Share with regards to understanding their product further and want to kind of get that evaluation done, you're most welcome to book calls with us. We PMS AIF World Platform has been actually dealing for last 4.5 years with all HNIs and ultra HNI clients in the space of alternatives, and we are doing very good work. And obviously, we are having very in-depth understanding about equities and asset class, because I have personally had an opportunity of conversing with all top thought leaders in the industry for a long period of time, and I myself have a good exposure towards equity as well as debt as an asset class, and have immense learning. But commercial estate as an asset class is something which we are open to understand, learn, and serve you along with some of these partners. And I think amongst various partners that we have been doing webinars with, Property Share is one very credible partner. So obviously it is important to understand and deep dive before we offer any offering to our clients. That is the intent, largely that we have, in this webinar. I hope, we have been able to add value. And for any further queries, you are most welcome to write to me or to my team. We'll be more than happy to address your queries. Thank you everyone for logging in. And thanks, Kunal, for your time.
Thank you so much.
Pleasure.